investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, you know, or the neighbor says, you know, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding. But that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period, and I've had that long period of stagnation from 48. From 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime in securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich, and you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains; it takes temperament.
And this is, I think, particularly relevant 10 years into a bull market. Is that I think you said more money has been lost anticipating a downturn than actually in the downturn. Can you explain?
Well, obviously the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
Warren, let's talk about some of the things that really resonated with people, and maybe start where you began the annual meeting this year, and that was talking to your investors and telling them a little bit about investing, some tips and lessons along the way. You kind of used it as a teaching experience at the top.
Yeah, normally I don't do that. I mean, in fact, I can't remember when I did it. We just go right into questions and answers, but I really thought that maybe we were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
See it, you move on to something else.
Are you concerned about the volatility in the
financial markets today, do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
I do think that there's a lot to be said for developing a temperament that can own securities without fretting. I think that the fretful disposition is it's an enemy of long-term performance.
Well, I think it's almost impossible if you're to do well in equities over a period of time if you go to bed every night thinking about the price of them. I mean, Charlie and we think about the value of them, but we would be happy, just as in that movie, if they closed the stock exchange tomorrow. Dick Grasso wouldn't be happy, and Jimmy McGuire, our specialist, wouldn't be happy. It wouldn't bother me and Charlie at all. We would keep selling bricks, selling dilly bars, selling candy, writing insurance. A lot of people have private companies and they never get a quote on them. We bought See's Candy in 1972. We haven't had a quote on it since. Does that make us wonder about how we're doing with See's Candy? No, we looked at the company results. So there's nothing wrong with focusing on company results. Focusing on the price of a stock is dynamite, because it really means that you think that the stock market knows more than you do. Now, the stock market may know more than you do, but then you shouldn't be in stocks. I mean, you should have, the stock market is there to serve you and not to instruct you. So you need to formulate your ideas on price and value. And if the price gets cheaper and you have funds, logically you should buy more. And we do that all the time. Where we make our mistakes, frankly, is where we focus on price and value and we start buying and the price goes up a little and we quit. Like Charlie referred to, we might have done on See's Candy. A mistake like that cost us $8 billion in the case of Walmart stock a few years ago, because it went up in price. And we are not happy when things we're buying go up in price. We want them to go down and down and down, and we'll keep buying more. And hopefully we won't run out of money. Of course, that's a different story. Charlie?
If you are not a speculative investor, if you're a long-term investor, and yet there are these speculative investors buffeting your returns about, what should your reaction be? Should you be doing anything differently?
I think basically you should not be doing anything differently. I mean, investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing. And say, how can I keep investing the day that the market goes down 600 points? That's the greatest time in the world to invest. It's certainly better than doing it the day before it goes down 600 points. And I think people have lost sight of the fact that a sharp market decline is, of course it's bad for sellers, but it's good for buyers. And since the stock market is the interaction of sellers and buyers, it's always good for somebody.
Right.
Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks. This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you're going to do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks, you shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down? In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.